So imagine that you're baking the perfect recession cake, and the base of this cake is made up of the 2008 mortgage crash. The icing on the sides and on the top is just the $30 trillion debt pile, and the decorations on the cake to give that finishing touch are the high interest rates with a little sprinkle of stagflation. My friends, welcome to the next couple of years, the utter end of the United States economy. Morgan Stanley just said that a $1.5 trillion wall of debt is looming for commercial US properties, and it's not looking great overall for the United States economy. This literally could be the final straw that eventually breaks the camel's back. By the end of 2025, this massive $1.5 trillion worth of commercial real estate debt will be due for repayment. And the significant concern right now is these borrowers figuring out who is actually going to lend them money. Smaller regional banks have kind of been pushed into the commercial real estate lending over the last year or so, and we all know of late these banks are having some serious issues of their own with things like bank runs. Morgan Stanley analyst James Egan said that refinancing risks are front and center for owners of properties from office buildings to stores and warehouses. The maturity wall here is front-loaded, and so are the associated risks. Morgan Stanley estimates that real estate property valuations could fall as much as 40% from the peak to the trough, which will increase the risk of defaults. And to give that 40% some kind of context, the commercial property only fell 15% in the year 2008, and it did end up leading to multiple banks failing and one of the biggest recessions on record. I would kind of argue that things right now are much tougher than they were in 2007 to 2009, but call me crazy. We've all seen in our own local areas shops close down from what happened in 2020. And let's be honest, a lot of them today still remain closed. As e-commerce has overtaken the old school method of going into a shop and actually commercing and buying a physical item, these locations have just simply not been able to keep up. Many of these locations are just simply still vacant, leading to a never-ending free supply of extremely overvalued commercial properties in this actual sector. I myself was looking for some commercial property to grow one of my businesses earlier this year. We've seen several properties, and the ones we wanted all wanted insane asking prices per square meter for the actual property. The one we were closest looking at was vacant for 12 years, and maybe there's a reason for that because they're too demanding. And of course we said no because they wanted more money for it than it was actually worth. It's absolute craziness. And by the way, that's not a guy who owns a building. That's one of the biggest real estate companies in Budapest. But if we head back over to the US, adding to this mass headache, as I mentioned, these smaller regional banks, which have been some of the biggest source of credit to the actual sector last year, have been rocked by recent deposit outflows and the demise of banks like Silicon Valley. This is causing a mass concern and worry that it will limit their actual ability to lend money to the people and businesses who actually need it. Morgan Stanley continued in their notes that the wall of debt is getting worse before it gets better. Maturities will continue to climb for the coming 4 years, peaking at $550 billion in 2027. Banks also own more than half of agency commercial mortgage-backed securities. James wrote, the roles that banks have played in this ecosystem, not only that as lenders, but also as buyers, and it will compound the wave of refinancing coming June. With rising interest rates and worries about banks defaulting, we've already started to see the hurt in CMBS deals. Sales of securities without government backing fell about 80% in the first quarter this year alone. And it does sound kind of bleak for US commercial property and banks in general, but it's gonna get worse, because when you exclude apartment blocks, the sheer scale of problems facing banks gets much more ghastly. As much as 70% of the other commercial real estate loans that mature over the next 5 years are held by actual banks, according to this Morgan Stanley report. They state that commercial real estate needs to reprice and alternative ways to refinance the debt that is needed. Europe is no better either. European real estate issuers, meanwhile, have had the equivalent of more than 24 billion due for repayment over the remaining of this year alone. Bloomberg intelligent analyst Tolu Alametu, look, Bloomberg, please stop picking people to do your reports whose name I just can't pronounce. It's like a kind of game now. But this lady said, we are definitely seeing real estate companies do whatever they can to deliver. scaling back investment programs, more joint ventures, bond buybacks where possible, and of course dividend cuts. She continued, disposals are a key focus too. Some recent comments from real estate issuers suggest that it's not easy to sell large portfolios. The long and short of it is, folks, banks are under severe risk. If you scratch just beneath the surface, there's a much bigger problem with commercial banking and retail banking than just simple bank runs. If commercial property falls 40%, it will send shockwaves through the entire US economy and in turn the world economy. It will drag most markets down, at least short term, with it. And as we know from the last big crash that was related to property, some banks will fail, some commercial businesses will fail, and even those who can afford to do business might not even be able to find money to actually continue operating, or at least fund where they want to operate from. To me, it kind of looks like a scenario where if you look left, you lose, and if you look right, you also lose. So why not look here, where there's a simple button that can make you richer? Thanks for watching, and good night.